welcome everyone to this month's monthly market update for June 2023. This month we're going to talk about relative performance related to large and mega cap stocks in the S&P 500 compared to the smaller stocks within the S&P 500. The reason why we want to bring this up as a touch point is because the performance has been some of the largest that we've seen in recent history. And we want to go through what those implications could mean for you and the overall market as a whole. So when we look at positioning, and positioning means where market participants are putting their dollars. Some cases you could see where the direct dollars are going based off of the performance of the indices like the S&P 500, which is a commonly followed index, or the NASDAQ 100, which tends to be more weighted towards technology stocks. You can start to derive sentiment as far as where individuals think these separate groups of stocks are going to go. And when we look at current sentiment right now from speculative investors, meaning investors who are betting on the market going up or down into the future, we can see a pretty large divergence here so far year to date. Over here on the left-hand side, this chart shows us that net speculative positioning on the NASDAQ 100, and again, that's a more tech-heavy, mega-cap focused index, is actually positive, meaning that people are betting that the market for the NASDAQ 100 is going to increase in the future. Contrast that to speculative bets on the S&P 500, and we see that the net speculative positioning is actually the lowest it's been going all the way back to 2008. Now, Ty spoke about this a little bit in last month's monthly market update, but we're starting to see how this performance is actually bearing out in the overall market. And you can see the NASDAQ 100 here in this goldenrod color has significantly outperformed year to date the S&P 500, that's the line down here. And part of that is because of this net speculative bet relative to the S&P 500 versus the NASDAQ 100. Now we can see this even further with the mega cap leadership, and there's two ways that you can look at it. The one was just by negative speculative investing, but then you can also look at it by equaling out all of the individual companies within the S&P 500, and that's what we've done here on the chart to the left. So the purple line here is the S&P 500 in its cap-weighted format, which basically means the larger the company, the heavier the weighting you're going to get in the S&P 500. And as of when this chart was taken last week, the S&P 500 is up about 12% year to date. Now, if you level out the weight of all 500 companies, meaning that every single company has the exact same weight in the index, that index has only risen about 2% so far year to date. And the implications of that means that you have the largest companies in the index carrying the bulk of the performance forward, meaning that it's very concentrated to individual companies versus more broadly or consuming more breadth across many, many more companies. And this divergence, this performance separation between the cap-weighted index and the equally weighted S&P 500 index is the largest has been year to date going back to 1990. So this is the performance difference up here that's a little over 10%, like we see in this chart to the left. So far through June 5th of the year, it's significantly larger than any other time period going back to 1990. So again, we're starting to see where a lot of the weight is moving towards or within the companies within the S&P 500. One final way to look at this, it's a little bit busy of a chart, but these are 7 out of the 10 tech names in the top 10 of the S&P 500. And on average, if you owned all of these tech names, you performed about 77% up so far year to date. That's compared with that 12% for the broader S&P 500 index right here. And then if you owned all of the top 10 stocks in the S&P 500 for the month of May, you were actually up about 9%, whereas the other 490 stocks were down about 4.3%. Overall in May, the S&P 500 was up a little over 0.2%. And so why do we say all this, and why do we show this big difference in performance between the largest tech-weighted names versus the rest of the market? Well, there's two things that we can take away from this. The first is positioning is very, very heavily skewed towards those top tech names, as you can see with the relative performance so far year to date. And what that tells you is that there's a lot of people that are positioning in these bigger balance sheets, these quote unquote safer balance sheets, because there was this fear of a recession that was imminent within the United States from an economic standpoint. There was also the fear of the debt ceiling that has since come to pass without too much fanfare. You also had the bank failures back in March that were starting to spook a lot of people as well. We think a lot of these potentially negative catalysts have come to pass, and there's clearer sailing into the future, which would suggest that the positioning within these larger, safer names may start to roll back and go into the broader index. Now, the second thing that you can say from a contrarian standpoint is because of this performance dispersion between the heavier tech names and the rest of the market, there's going to be a reversion to the mean or an equilibrium between the two. And that's where that repositioning comes in, where people may be saying, okay, we may be in the clear economically speaking. Now we can get into some of these other stocks that may have not performed as well because all the money was flowing into the tech-heavy mega cap names. So these are all things that we're keeping an eye on. Certainly here recently, market performance has been relatively good overall, but there's a lot of months left in the year. So we'll be keeping an eye on this and many other things going into the future. Again, as always, if you have any questions, please feel free to reach out and let us know. We'd be happy to answer for you. Thank you very much.